What's happening, guys? I hope you're doing well. Hey, today I want to spend a little bit of time with you, kind of going over the housing market as we see it for the whole year of 2023. So where are we at today? Where are we headed? Where are interest rates at today? Where are these crazy rates going to be at the end of this year? And hopefully with all of that, you can use that data to help yourself, make a better decision moving forward. Maybe you're moving up, maybe you're buying your first house, but all of this information would be incredibly helpful to have just to make sure that you're making an informed decision moving forward. So let's take a quick deep dive in. But before we dive into the interest rate portion of it, we want to take a look at some of the negative media that's out there just to frame up a couple of things. So this particular article right here shows $1.5 trillion worth of equities just vanished. It's lost, it's gone. And I think if you're not in the mortgage business or in the real estate world and you just don't have enough data, you'd see something like this and just back out. You get completely out of the market. There's no way you're moving forward. That same person who had posted that had also been historically quoted as saying the market's worse than 2006. It's a big bubble. Home ownership doesn't build wealth. It's better to rent. And so over these years, Diana, who was the one that tweeted that, has been basically saying, get out of the market. Don't buy in the real estate market. It's not worth it. It's too high. And what we did on this side over here is we wanted to kind of show you, hey, if you listen to that negative media and you listen to that bad advice, what would have happened to home's equity? What did you lose by doing that? So the top section up here, we took a $300,000 house and we applied the average appreciation nationally to that specific home starting in 2015, and you'll see it start to stack up. So 5.1% 2015, 5.4% in 2016, 2017, 6.1%. You see how the growth or the equity position over time starts to stack. And so this is clearly against what she's saying, where it doesn't build any kind of wealth. It obviously builds a ton of wealth. You could have sold the home somewhere in here and walked away with a nice healthy profit. But if you would have held on to it, hypothetically, that home would be worth somewhere around, $400,000 or $500,000 today. And certainly a lot more than the 300 grand that you paid for. Plus, you didn't have to pay rent the whole time. Your principal balance would have been drawn down, and you would have had a fixed rate mortgage versus rent, which we saw increase steadily over the last couple of years. So just a reason why you don't always want to listen to the media. You do want to take a deep dive into all of the data points, but sometimes just a quick article like that telling you, hey, the market's bad, or a quick article saying, hey, the market's hot. Kind of pay attention, like spend a little bit more time on that so you can come up with your own conclusion. Plus, we need to drill down on specific areas for this. Okay, so as we jump into our 2023 forecast, the first thing I want to do is I want to kind of explain and frame up for you how interest rates work. We think that interest rates will drive down over this next year in 2023. One of the reasons why is the relation between long-term mortgage rates and inflation. And so on this chart, we're going to take a look at the 30-year fixed mortgage, and we're going to look at the CPI, so the core consumer price index. So this is basically what the Feds use to come up with their measure of inflation. So if they're telling us inflation's too hot, or it's balanced, and it's reasonable, they're going to use the CPI to determine that. CPI basically strips out food and energy, so things that monetary policy isn't going to impact. Okay, so all of the egg prices that you're paying for, those are not factored into CPI, but this is stuff like housing, manufacturing costs, things like that. So this is measuring that sort of inflation. And normally a 30-year fixed mortgage and CPI, they're going to kind of be in lock and step. They're going to follow each other. So if inflation starts to kind of rear up a little bit, mortgage rates will come up. If inflation's dropping a little bit, mortgage rates are going to drop. And you can see that in the chart. There's a section here where inflation actually starts to gain a little traction and show that it's getting a little bit high. And this is right around that period of time where the Feds are basically saying, hey, inflation's transitory. This is going to be here for just a few months and it's going to go away. Don't worry about it. It's okay. And to keep the market stable during that time, that's where this QE period kind of came in. So to keep it stable, they decided it would be best to buy mortgage-backed securities. And they spent trillions of dollars. I mean, there's like hundreds of billions of dollars per month that were invested into mortgage-backed securities to drive the mortgage rates down so that they weren't spiking right away with inflation. Well, as soon as they stopped doing that and they realized inflation's probably going to stick around for a little while, look what happened to the mortgage rates. They started to kind of follow. So they were unaffected here because they were being subsidized by the spending. But as soon as the spending stopped, now you have this peak or this kind of run up here on inflation, but you also have mortgage rates that are doing the same exact thing. And you see right here, inflation starts to dip a little bit. Mortgage rates are also dipping just a tad. So how do we kind of know where inflation is going to be in the future? We can actually track it using this CPI chart. So this particular chart is showing that it's currently about 6% year over year on the CPI. So that's where the inflation is tracking. But the way that they look back on it is they do a look back. And so there's a comparison or a replacement that will happen, which will start to drive things down. So inflation looks like it's higher if your old data, so if your data, let's say you're in 2021 and your data from 2020, let's go December here, is 0.6% for 2021. But if 2020 for December was much lower, it's replaced with this 0.6, it's going to look like inflation's ramping up. And so now you have these new markers for 2021 that are being compared in 2022 and in 2023. 2023 especially is going to have some of these higher markers. And so what's kind of nice is it actually shows us it's going to replace these higher numbers with lower numbers in the future. And you can actually see that starting here. So the November one, that this 0.5% was replaced with 0.2. It looks like inflation's driving down a little bit. And so we have a lot of these higher markers right here, especially as we get into April, May, and June, which will be replaced when we see the 2023 report. It's going to replace them at a much lower rate, and it's going to drive that inflation number down just a tad. One other thing that you want to pay attention to is the spread between a 30-year fixed mortgage and a 10-year treasury. And so this is really, really telling. I want to explain this a little bit because this is something a lot of people are not talking about right now. So right up here, you've got your 30-year fixed mortgage. You've got underneath it in the blue, this is your 10-year treasury. And look, they're not perfect. They don't meet like a puzzle, but they're really, really close. So as the mortgage rates are kind of moving around a little bit, you'll also have the treasury moving around right about the same. And the gap between these historically is going to vary somewhere between maybe 175 basis points, 200 basis points. That's the spread. It's kind of the profit margin on a mortgage, let's say, versus a 10-year treasury. It's how banks get paid and all of that. Well, here's what's happening right now. Right now, that spread, somewhere around 300. It was actually even a little bit higher at one point, but it's bigger. Why is it bigger? Well, are banks trying to make more money? Well, there's a servicing cost to a loan. And so you can operate a bank, if you wrote a 30-year fixed mortgage, you've got to have staff there that are going to be there to help manage payments. They're going to be able to send out late notices, 1098s at the end of the year, all of that stuff. And so there's a servicing component of that costs money. And because of that, there's a yield spread that needs to be considered to help cover that and make a profit, because these are banks. They're trying to make some money on this stuff. And so realizing that a lot of the mortgages that are written right now are likely to pay off much, much earlier, that servicing premium that they're kind of forecasting normally would be like a 5 to 7 year window. They're looking at a much shorter period of time because they don't think that these rates that are in the 6s and 7s are going to be around for a long time. So the only option for them to do that is basically go, hey, we'll make more money today up front. This is why some of the loans have points in them from day one, because they need to make a spread right up front, get that money up front to pay for that servicing. That loan pays off in 9 months, 12 months, or 18 months, or whenever interest rates start to look a little bit better. They're not hurt as bad. If they maintain a normal spread like we're seeing right here, there's just not enough room in there, and they will actually end up losing money. Servicers have seen in the past in some markets where they've lost billions of dollars, and so they had to create a little bit more spread right here. So this is one reason why, again, we think not only us but also smart money on Wall Street, servicing, et cetera, are all predicting lower rates in the future, and they're building it into their model right now. They're saying, look, we need to make a little bit more money on this up front because we know that rates will be a little bit cheaper in the future, and they're going to pay off a little bit sooner. So on top of inflation kind of impacting mortgage rates, as the servicing value starts to come down, that also frees up more room, which drives interest rates a little bit lower. So let's watch out for that here in 2023. I want to talk a little bit about, the R word, the one that scares everybody. It's recession. So when we talk about recessions and we say, hey, recession's coming, this is a really, really cool slide that I thought a lot of people would kind of get a kick out of. So we're looking over here on this axis right here. We're looking at billions of dollars, and this is credit card usage for households. And so we go back into 2018, somewhere right around $780 billion worth of credit card debt. That number was steadily increasing all the way up through here. So if you see this little shadowy mark right here, this is really right around the COVID-19 pandemic age right here. And then all of a sudden there's lockdown, and look at the drop off. So people are not traveling anymore. They're not spending as much. They're staying home. And so the credit card usage completely dipped down dramatically. Well, at the same time, so this is January 20, or right around like March of 2020, right over here, look at what happened to the personal savings rate. It went like through the roof. So personal savings was almost at an all-time high because the credit card debt. So again, we're not spending, we're not putting on credit card, we're just packing away that money and we're saving it for a rainy day. This is exactly what was happening here. And you got a couple of little spikes here. So we talk about like personal savings, these little spikes, these are your stimulus packages. So when stimulus kind of came up, it spiked out the savings for the household. You can see those both right here. But ever since then, it's had a drastic decline down. It's starting to kind of roll back. People are kind of getting into their bad habits again. And you can actually see how it correlates with credit card debt. So credit cards start to stack over and over and over again. And right now we're sitting somewhere around or just under $1 trillion. You got $920 billion worth of credit card debt. So this is one reason why we think that we move into recession. So as people stack, they will at some point run out of resources, and then they're going to roll back on their spending. When they roll back on their spending, the economy as a whole just doesn't have the numbers. It starts to slow. If you look at the economy as like a business, the customer's not spending anymore there. And so that will push us into recession. So what happens, or actually, let me back up one here. There we go. Let's talk a little bit about one more indicator about recession. So this is an inverted yield curve. This is basically a long-term bond versus a short-term bond. And normally, if you're going to stack away your money, let's say you're going to give it to the bank and you're going to take out a CD, a long CD, you would expect to get a higher yield on it because you're going to lock up that money for a longer period of time. But if you only wanted to get maybe a 6-month CD, your profit on that, your percentage, your APY that's being pushed back out to you should be a lot smaller because you're only giving the bank that money for a short period of time. You would expect a shorter return. It's flipped right now, because the future, a little bit fuzzy, and the short run, we can see a little bit more clearly. And so they will give you a little bit more money to hold your money right now, a little bit more return to hold it in the short term versus that long run that's just too fuzzy to see and predict out in the long run. Anytime that happens where it flips like that, that is right here. So this is called an inverted yield curve. All these little shadowy boxes that you can see right here, these are US recessions. And so you can see we invert, and then there's a recession. We invert, recession, invert, recession, invert, recession, all the way through. It's almost a perfect predictor of recessions. There's a little tiny one right here. And we actually were sort of moving into recession, and then COVID kind of mixed all that up. Stimulus money went in, the whole story there. And so that kind of got paused, but look at where we are right now. So future casts us out a little bit. Pretty sure there's going to be a gray bar right here. That's where we either in recession at the moment or we're headed into recession down the road. So what happens to mortgages when we're in recession? Because I think recession has that negative tone, and we get really, really nervous about where things might actually be. How is it going to impact us? Mortgage rates, are they going through the roof? We just saw them go up. They were at much higher rates than they used to be in the past. And these are, again, shadowy boxes, recession. These are your mortgage rate activities. So rates typically will pop up a little bit and then they'll come back down. So as we're pulling out of recession, they'll start to dip. So this particular one went from 16%, it spiked up down to 11.75. This one went 18%, but it had a dip at the end of the recession down to 13. 11 to 875, 7.3 to 675, 6% to 4.875, and the most recent one here in 2020, which again, right before the pandemic, 3.75 to 2.75. And so we've had a nice little run up here. This, if I was to pull this out a little further, this would kind of sit somewhere in this range right here. We feel like it's going to pull back down probably a good amount, probably somewhere in this 5% range at some point in 2023. What happens to housing during recession? This is another question that comes up all the time. Well, certainly if there's a recession, housing has to drop off, right? It's going to fall on its face. And the reason we think that is because of this. This was the Great Recession. This was basically the housing crash, all those kind of crazy arms and pay option arms that were put into place back then. This is our recency bias because this is the last recession that we actually can relate to. And we saw housing prices really take a nice dip off. But historically, if we go all the way back to the 60s, again, recession on each one of these bars, housing prices here, really pretty flat, kind of move up, a little bit of an increase, flat, a little bit of an increase, flat, increase coming out of it, flat, increase coming out of it. So usually housing will hold pretty well on their value. This was a housing related recession. And so this was because there was a lot of really nasty loans that were out there. The money that was put out into housing, there was overbuilding, there was all sorts of things that were contributing to this. And so because of that, house prices did fall, and they fell drastically back in 2006, 7, and 8. And you can see, if you were to take like a little graph here and just kind of draw a line, like scrub off this top, get rid of the super low bottom, we kind of keeping this nice little pace. We have a spike up here. It's also due to stimulus and money supply. And so we think, again, recession right here, probably flatten out, maybe top a little bit. This is actually what I think. I think we top, some of the gains that we saw and then carry on with a more normalized pace. This is the months of inventory slide here. So if we go back to 2011 and we take a look at where things are at, this is how many months of inventory were on the market at any given time. This means if you took on no more homes, how many months would it take to go through all those homes based on demand? Well, so the peak was around 9.5 months. It's a long time, especially with no new homes hitting the market. To just exhaust all of the inventory would take 9.5 months based on buyer demand. You can see these were just generally declining down. These are all seasonal. So when you see January here, each year, inventory will kind of dip and then it starts to kind of spike back up a little bit. So you can see the seasonality every single year right here. And if you look here at January of 2022, almost one of the lowest inventory levels on history, and it has been increasing, but it's not at an unhealthy pace. If you kind of look here, a little over 3.5, maybe call it 4 months worth of inventory, that's pretty healthy. Some markets are a little bit worse than others. So again, you got to take a peek and see what's going on in your local market. This particular slide is really, really telling. And one thing I want to kind of point out here, I just want to explain exactly what you're seeing right here so you can relate a little bit to, where we are today. So this brown or orange column right here would be the amount of buildings. So this is the annual completions for new construction. And then you have your household formation or household growth. And so this would be like if I have 3 kids and then they leave the nest and they go out and they start their own families or have their own housing, then my household went from 1 to 4 because now it's my household still there, but then I have each one of the kids that are out there creating a new household, whether it be married or single, but they're out in the world, right? They're no longer under my household. And so when we look at this, these are all in millions right here. So we had just over 1 million household formations back in 2002. Builders were trying to get ahead of it. They were using some predictive factors to say, hey, we need to build more. There's a lot more people that are coming, and you could see they were actually right. They were building almost spot on right here. And then it dipped off like crazy in 2006. Why? Well, this is because there was a whole lot of compression within the economy. So again, that area, a lot of job loss. Households were delayed on their formation because of job loss. And so they tend to, if you don't have a job, you're probably not going to move out and get an apartment or a house. So you're going to stay put, stay home. And so we saw a massive drop off here, but building kept going. And this is one reason why we saw such devastation back in 2008 because there was just an overabundance of building versus the amount of demand that was actually in the market. It was forecasted that you were going to need that, but it ended up not needing that much. And you can see they still overbuilt. They cut. Builders are starting to cut, but they had projects already in the works, so they still overbuilt. Finally got caught up sometime in 2011. It's kind of the bottom of the market. Everything from there started to kind of pick back up. But what's going on right now? Builders were a little bit gun shy. They're like, hey, man, we're not getting back into this. We don't want to use all the predictions and then come up here and overbuild again. And so you currently have households formations that are outpacing construction. That's one reason why inventory levels are so compressed right now. And on top of that, you have the cost to build. So you have the affordable housing isn't necessarily going to be these single family homes that you can buy for a couple $100,000 brand new. These are going to be apartment units because it's cheaper to build up than it would be to build on scale with a bunch of cookie cutter starter homes. And so as these households form, a lot of the demand is going to be that lower priced inventory, and it's not necessarily going to be for sale. It's kind of one of the major problems that we're going to see. One reason why, I thought this would be a good slide to kind of point out, 2008 versus today. So job cuts leading up to the Great Recession of 2008, there was 8 million job cuts. Today, there's nothing. In fact, last week, there was a jobs report came out right around 512,000 or 517,000 new jobs that were created. So obviously there's job loss, but there was more job gains than there were loss. And so there was a positive number, 517,000. On payroll, and this is according to ADP, the last housing cycle, 130 million people were on payroll. They were getting paid. There's 153 million people now. So you have 23 million more people that are actually getting a paycheck. Total jobs also increased. So this is based on a household survey. So this includes people that are self-employed as well. Subprime loans, we all know those loans that the payment, they took away the teaser rate and payment went crazy. Those were pretty heavy in the marketplace back in 2008. They don't exist anymore. There's a lot of rules around that called, one of them called QM, where you actually have to prove the ability to repay. And so that prevents a lot of those loans from coming back into marketplace. Construction was at 7.6 million. So the 5 years leading into the recession, 7.6 million homes were being built, only 4.6 today. Inventory in the market, 3.8 to 4 million homes, 1 to 1.2 today. So again, about a third of the inventory that we were seeing back during the recession or leading up to the recession. Mortgage delinquencies. This is one that a lot of people get really concerned about as they go, what about all the people that are late on their payment? Well, back leading up to the recession, about 10% of all mortgages were in some kind of a delinquency, at least 3 months behind. Today, only 3.6. Now, that number actually is probably a bit higher than reality because that includes people that are in forbearance. They're not necessarily behind, but they were taking advantage of a forbearance opportunity where they didn't have a credit impact, pushing off their mortgage payments for a little period of time. That was part of the COVID and pandemic timeline. And so having that in place gave them maybe a little bit more agency to stop making their mortgage for a small period of time, maybe 6 months or a year, focus that money on other debt. We've seen a lot of that. I've actually heard from a lot of people that took advantage of that and kind of used it to their advantage, but they're factored into that 3.6 because they're currently not making that mortgage payment. What happens at the end of the forbearance? Basically, the lender will take that principal that was not being paid, they stick it on the back of the loan. So you still pay it, you're just paying it in the future when you sell the house. And so it's not a negative impact on the credit. It will not turn into foreclosure. Foreclosures were sitting somewhere around 4.6% of all of the mortgages that were out there actually made it to foreclosure, and it's less than 0.6 right now. A couple of things to kind of think about on the foreclosure side of things. So there is so much equity within homes. Remember, leading up to kind of the Great Recession, a lot of these homes were financed at 100% financing with crazy interest rates and crazy programs that made them really affordable for a small period of time. And so when they went to go sell those, there was not enough equity to sell it. Today, we've had such a nice run up on value, plus the down payments are there, that if somebody was really in a desperate situation, they actually have the room to sell and walk out, maybe just break even, or probably in most cases profit with a little bit of money. So they're not going to let that property go to foreclosure if they can. We talk about housing crashes. I thought this slide, and this is just a quick zip code in my backyard here in Palmdale. I took 93551 here in Palmdale, and I wanted to do a look back. And I thought, people are like, hey, the market's really kind of falling apart. It's backing off a lot. But let's take a look at what was going on. So down here at the very bottom, $560,000 in December of 2021, that was the average home sales price for 93551. And if we look at it today, so we take December of 2022, it's 550. So it's off 10 grand. So it did roll back, only down 1.8%, not crashing in any way. What you did have is you scrubbed off a lot of the gains. So the peak of the market would have been here like May, June of this year. That would have been the peak. And so you probably, if you bought at the peak versus today, probably have lost a little bit of equity position. Nothing super, super dramatic, but maybe, 8 to 10%, because it ran up and then it pulled back down. Now it's a little bit more even, and it'll probably continue at a more normalized pace moving forward. So you'll get back to these same levels, but you're just going to get back to them at a more slow, more normalized pace versus this rapid increase that we've seen over time. Let's talk a little bit, going back to foreclosures. This slide was just slightly out of pace, but I wanted to show you, 2008, 9, 10, look at how many foreclosures were out there on the marketplace. 1.3 million, 1.5, 1.6, massive amount. Today, 164,000. So way less than the market crash that we had back in 2008. And this is important to note. In 2020 and in 2021, there was a moratorium on foreclosures. And so you couldn't foreclose. You just had to kind of wait and sit it out. And so as you start to hear reports about foreclosure rates doubling, things like that, there's a catch-up period that is basically going to be because, if you look at 2020, you had 165,000 homes that were foreclosed. 2020 went down to 65,000 nationwide. Massive, massive dip. We probably should be somewhere around this 160 to 2 something. And because of all of the miss in 2021, we'll probably see that bump up over the next year here in 2023. So you might see this number increase into the low 2s, but still historically really low. In fact, if you compare, got a number at like 250, it's half of 2016. 2016, there wasn't really a whole lot of comment about foreclosures. Affordability is under a lot of people's mind because we have things in our life that are way more expensive: egg, food, gas, utility costs, all of that stuff, super expensive. And so I thought it'd be neat to kind of show you a little bit of where we have been at here in 2021, where we were in 2022, and where we're moving to in 2023. So let's take a sample here. Let's just say somebody put 20% down on a $400,000 house. Back in 2021, with a rate of 3.5, they would have had a mortgage payment of $1,796. And we knew that in 2022, we saw a lot of those prices, even at the peak, kind of bump up a little bit. So let's assume that, 400,000 went up to 440, but the rates were at 6.25%. So that mortgage payment's off. It's $2,709, $913 more expensive. And again, big red flag, right? It would tell you to stay out of the market. The average household income to buy this house would have been somewhere around $9,000. And according to ADP, during 2022, the average person that stayed on their job got about a 7% raise. The average switcher, somebody left the job and went to somewhere else, probably picked up about 15%. Remember the media talking about all the people that, all these unemployment, but they were kind of staying on stimulus for a while, so nobody could get anybody to come out to work. Well, if you were switching jobs or taking jobs, you were getting paid for it. And so the average was about 9% on your income. That's about $817 gross, $612, give or take, after taxes. So even though your cost of living on your housing went up $913, you actually were making about $612 more. So you're still off, but you're not off that much. 2023, let's just say that the prices were at the same peak as they were in 2022 at 440, but now rates start to dip down. Let's just we think they'll actually be sitting kind of in the low 5s. We'll use 5.25 for right now. That mortgage payment would be about $2,429. So that's $633 more than 2021. And you would have had an increase if we cut this is 9% average increase. If we cut it almost in half and go to 5%, just be kind of conservative on the amount of income that a household would get, be another $858 gross, 643 net. That gained 633. So now we're pretty even. So we're kind of almost the same, if not maybe a little bit better in affordability than we were in 2021, even though interest rates are a couple percentage points higher than what they were in 2021, and the sales price is higher. I think that's one thing that you really want to pay attention to. So when you look at the entirety of everything, now this may not be your specific scenario. You may not be the one that's making more money. Your household's not making more money. But these are averages. They help us kind of forecast things out. So this was a really, really fun slide to throw in. What are the billionaires doing? What is the big money doing out there? JP Morgan Chase, they were acquiring $1 billion to buy single family rentals. So think about that for a second. Why would they spend $1 billion to go out and buy a bunch of single family homes? It doesn't really sound like, where big banks kind of park their money to make a bunch of cash. Well, you've got a volatile stock market ahead of us, potential for recession. Stocks typically do poorly during that time. So why not allocate some money into an area that they feel confident in? So if they're confident in single family rentals and they see that there's a lack of building, low inventory, the surge of demand, they know that rentals will be very strong and it's going to give them a nice cash flow position. So just something to kind of consider on your side. So our forecast for housing, lower inflation will start to gradually come down over time. Probably going to feel a recession. I don't want to call it a recession. I think it's probably going to end up there, but recession like slowdown, which would be kind of a flattening of the market, maybe a more normalized pace on appreciation. Incomes will help the affordability, and then a very tight housing inventory. This is an area that I kind of called this a little while ago. I was seeing a lot of the interest rates that people had fixed in. They were in the 2s, 3s. So there's a thing called a lock-in effect. If I had a really low interest rate on my mortgage, I'm not necessarily looking at that next property up because now I'm going to lose that 3% mortgage. I can't carry it over. It's not portable to the next house that I buy. I'm probably going to double my rate of interest, and it's going to cause me to pause. Well, if I pause and there's not enough new inventory coming in from new construction, it means less homes on the market. We actually see that being exacerbated a little bit here in 2023. And rents will still be high. They're starting to normalize a little bit. They're not going to crash. It's not like a house that was listed at $2,800 magically going to come on the market for $1,800. But they'll start to normalize. So they may not go from 28 to 32. They may stay at 28, maybe go to 28.50, 29, somewhere at a more normalized pace. Low single digit appreciation for most of the US. So again, zip code by zip code, county by county, this is going to vary a little bit. There are some markets that need to kind of roll back on their values. They were a little bit too hot. They kind of went the wrong way. And there's plenty of them that actually are maintaining, actually still showing gains. If I go back a couple of slides here let me go back to this one. I actually had run this on different zip codes, again, kind of in our backyard. And we saw here a 93551, a 1.8% year over year loss. But there were other ones that were showing a 3 and 4% gain year over year. And so it just depends on affordability, depends on specific zip codes. So that's one reason why you got to talk to a professional about the exact area that you're looking at to see if it makes sense for you to buy or not. So the mortgage rate forecast. So what are our headwinds? We've got quantitative tightening across the globe, potentially a global recession. So that could be concerning. That will actually probably drive rates down, like we just talked about. Inflation coming down will actually help mortgage rates. You've got more debt to be kind of financed over time because our sales prices are quite a bit more. But the tailwinds, lower inflation, excessive retail inventory, increasing mortgage and servicing values. So remember that value I was showing you where the average is 175 to 200 basis points in servicing is actually closer to 3 right now. That's going to drive down a little bit. So that's also going to pull interest rates down as well. So we think at the end of 2023 or sometime that the first time you'll probably see a little bit of a pickup on rates is going to be, somewhere mid-May, early June. So we're going to start to see them actually make their initial descent down and start that trend a little bit lower. And so we think at some point, 5% mortgage rates with the US Treasury sitting somewhere around 3% or so. All right, guys, hopefully you find this helpful. Let me know if you need any specific data for you. I can build that. You guys can scan the QR code here on the screen. If you want to set a quick call with me, it'll bring you right to my landing page. You guys can set up a a consultation, look at a loan app, figure out your pre-approval range, and just generally get prepared for the market if you feel like it's a good fit for you and your family. All right. I hope you guys have a great rest of the week, and we'll talk to you soon.